If you would like to make great profits within a short period of time with low risks, you need to do all the following tasks. 1. Always learn. Learn some macro analysis, fundamental analysis, technical analysis and cycle analysis. Macro analysis is about the economy, fiscal and monetary policy, interest rate, inflation and employment, etc. If the macro environment is not looking good, you need to be careful. The most important thing is liquidity in the market. Fundamental analysis is about company strategy, industries, competitors, and markets, leadership, financial statements, operating efficiency, and valuations, etc. If you understand the company you are trading, you have a better edge to win. The most important thing is company valuation. There could be many hidden values in the financial statements. Technical analysis is about chartings, patterns, trends, indicators and overlays, etc. It's very useful to understand the trend and predict the future of price movement. But sudden fundamental changes and big money can change the trend. The most important thing is to know whether it's trending or oscillating. Let the profit run and cut the loss quickly. Cycle analysis helps you understand the long-term patterns and trends. For stocks, there are accumulation and distribution cycles. For the stock market and economy, there are boom and bust cycles. During a lifetime, you could experience 3 big economic and stock market cycles, where you could have a chance to change your life. There are also some important concepts that you need to know. PEG, price earnings to growth ratio, is a valuation metric for determining the relative trade-off between the price of a stock, the earnings generated per share, or EPS, and the company's expected growth. A stock with lower PEG less than 1 is potentially a good candidate. Intrinsic value. Intrinsic value is a core concept that value investors use to uncover hidden investment opportunities. When a stock's market price is below its intrinsic value, it may be a smart investment. Margin of safety. When the market price of a security is significantly below the estimation of its intrinsic value, the difference is the margin of safety. Because investors may set a margin of safety in accordance with their own risk preferences. Buying securities when this difference is present allows an investment to be made with minimal downside risk. Relative strength. Relative strength is a strategy used in momentum investing. It focuses on investing in stocks that have performed well relative to the market as a whole, or to a relevant benchmark. A stock with higher relative strength is usually the leading stock with a strong trend. AAII Investor Sentiment. Investor sentiment is measured with a weekly survey conducted from Thursday at 12:01 a.m. until Wednesday at 11:59 p.m. Tracking sentiment gives investors a forward-looking perspective of the market, instead of relying on historical data, which tends to result in hindsight bias. Fear and Greed Index. The Fear and Greed Index is a way to gauge stock market movements and whether stocks are fairly priced. Extreme fear or greed could cause the market to turn to the opposite side. Max Pain. Max Pain, or the max pain price, is the strike price with the most open options contracts, and it is the price at which the stock would cause financial losses for the largest number of option holders at expiration. Market makers get the max benefits when options expire at the max pain price. Accumulation Distribution Indicator. The accumulation distribution indicator is a cumulative indicator that uses volume and price to assess whether a stock is being accumulated or distributed. It seeks to identify divergences between the stock price and the volume flow. This provides insight into how strong a trend is. 2. Develop your own investment or trading system. Pick the right stock based on fundamental analysis, read stock charts and technical indicators. Timing for the entry and exit, set stop loss and stop wins, and with good money management. Have good discipline to execute your investing or trading system. You can refer to guru stocks, like what Warren Buffett is buying, or pick the leading stocks in different industries. You need to find the leading company with good fundamentals in the hot industry, and with a technical breakout with big volume. 3. Diversification. You can't put all your nest eggs in one basket. You have to find at least 15 stocks in different industries to make an investment portfolio. Each stock is totally different, so you need to do lots of work to make a balanced portfolio. 4. Keep learning. Summarize and learn from your mistakes. The stock market will always be changing, and there is no holy grail. You have to keep up with all the new developments in the world and technologies.